All right, folks, let's buckle up and dive into the fascinating world of fixed income markets. Now, I know bonds and debt instruments might not sound as flashy as stocks, but trust me, they're just as crucial to the financial system. Think of fixed income markets as the quieter, steadier sibling of the stock market, helping companies, governments, and organizations get the funds they need while offering investors stable income. So let's break down the structure, the players, and the mechanics that make this market tick. To kick things off, let's talk about what makes fixed income markets unique. Unlike equity markets where stocks are traded, here we're dealing with instruments that have defined maturities, meaning they come with an expiration date. Bonds aren't forever. They've got a start and an end, which is a big deal when you're deciding whether to invest in them. Fixed income markets are all about balancing between credit quality, time to maturity, issuer type, currency, geography, and even ESG, environmental, social, and governance characteristics. These attributes help us classify bonds, build indexes, and most importantly, make informed investment decisions. Market structure, primary versus secondary markets. Let's break down the two major parts of the fixed income market structure, the primary market and the secondary market. Think of the primary market as the launch pad. This is where new bonds are born and where issuers raise fresh capital by offering these bonds to investors for the first time. It's like a debut party for a new bond. Then we have the secondary market. This is where the real action happens. It's the marketplace where these already issued bonds are bought and sold among investors. It provides liquidity and price discovery, which is a fancy way of saying it helps investors find out what a bond is really worth based on current market conditions. Imagine a company like Apple decides to issue a bond for the first time. They go to the primary market, attract investors, and boom, the bond is issued. But once it's out there, those bonds can be traded on the secondary market like baseball cards at a swap meet. If interest rates drop, those bond prices might go up and investors start trading. Fixed income segments. Who issues bonds and why? Now let's talk about the different segments in fixed income markets. Who's issuing these bonds and who's buying them? Issuers can range from governments, think treasury bonds or municipal bonds, corporations like Apple or IBM, to supranational organizations like the World Bank. Each issuer has its reasons. Governments might issue bonds to fund infrastructure projects, while corporations might use them to expand operations or manage cash flow. Credit quality. Bonds are also classified by credit quality, which is just a fancy way of saying how likely the issuer is to pay you back. Bonds rated AAA are top-notch, like your A+ student, while those rated below BBB- are considered high-yield or junk bonds, riskier but with higher potential returns. Time to maturity. This one's straightforward. How long until the bond matures and the issuer pays back the principal? It could be less than a year, short term, between 1 and 10 years, intermediate term, or more than 10 years, long term. Longer maturities generally mean higher interest rates because, hey, you're taking on more risk. A city government might issue a municipal bond to fund a new school. It's likely rated investment grade, say AA, because city bonds are generally seen as safe. But if a tech startup issues a bond, it might fall into the junk bond category if its financials are shaky, offering higher yields to attract investors. So who buys these bonds? Fixed income investors range from money market funds looking for short-term, low-risk investments to pension funds and insurance companies that might go for longer maturities with higher yields. The trick is to match their investments with their future liabilities, like ensuring there's cash on hand when people retire or claims need to be paid out. Investors build portfolios to meet their future needs and manage risk, and their strategies often vary across the credit and maturity spectrums. At the conservative end, we have default risk-free investments where safety takes priority. Short-term investors here gravitate toward money market funds for liquidity, while those with an intermediate focus turn to financial intermediaries and central banks for stable returns. Long-term players like pension funds look to grow assets steadily over time. For example, money market funds like JP Morgan's Prime money market fund are popular with short-term investors for their liquidity and low risk. On the other hand, long-term players such as pension funds like CalPERS, California Public Employees Retirement System, focus on slow, steady growth to ensure they can meet future retirement payouts. Moving into the investment grade category, we encounter a moderate approach to risk. Short-term investments here often come from corporate issuers seeking immediate funding. For intermediate horizons, bond funds and ETFs offer a balanced mix of return and stability, while insurance companies dominate the long-term space, carefully managing risk to protect their portfolios. At the higher risk end lies the high yield category, appealing to those aiming for more significant returns despite greater volatility. Short-term investors such as asset managers dive into this space for quick gains, while intermediate players like hedge funds and distressed debt funds embrace the challenge of higher risk debt in pursuit of attractive returns. Each investor type applies these strategies to balance risk and reward, creating portfolios that can endure through market fluctuations. You've probably heard of credit rating agencies like Moody's and Standard & Poor's, S&P. These agencies act like school teachers, giving bonds grades based on their risk of default. Investment grade, bonds rated BBB minus or higher are considered safe bets. Think of them like your straight A students. High yield, junk bonds. Bonds rated BB plus or lower are more like C students. There's a chance they might not pass the final exam, means they default, but if they do, they could reward you handsomely. Fallen angels. These are bonds that were once investment grade but have slipped into junk territory. It's like the former honor roll student who's suddenly failing math. Consider a fallen angel like Ford back in 2020. Once an investment grade issuer, it fell into high yield territory when the pandemic hit. Investors who bought the bonds after the downgrade could earn a higher yield, but only if Ford managed to get back on its feet. Let's talk about fixed income indexes. Just like stock indexes, these track the performance of a bunch of bonds grouped together based on things like sector, credit quality, or geography. But here's the kicker. Bond indexes are a bit trickier than equity indexes. Bonds mature, get called, or new ones get issued, meaning the index constituents are always changing. It's like a football team that keeps swapping out players mid-game. And because government debt is a major part of these markets, they often dominate these indexes, skewing them towards sovereign debt. Primary versus secondary fixed income markets, where the magic happens. So back to our two major markets. The primary market is where bonds make their debut. Issuers raise capital here, and depending on who they're targeting, they might go for a public offering open to everyone, or a private placement, a more exclusive club. Public offerings. Think of these like big blockbuster movie premieres. Everyone can buy a ticket. Private placements are more like an indie film screening, only for select viewers. Secondary market. This is where those bonds continue to trade after the initial issuance. This market is mostly over-the-counter, OTC, meaning it's decentralized and happens over electronic platforms rather than a central exchange. It's where the bond market's heartbeat really lies, offering liquidity to investors who want to cash out or adjust their portfolios. A government might issue new bonds through an auction in the primary market. Once those bonds are sold, they're traded among investors in the secondary market, where the price might fluctuate based on interest rates, economic news, or even political developments. Liquidity and market dynamics, finding the sweet spot. When we talk about liquidity in the bond markets, it's all about how quickly you can buy or sell without causing a big move in the price. Sovereign bonds from developed countries, like US Treasuries, are super liquid, trading with tiny bid-offer spreads. On the flip side, older or less traded corporate bonds might have wider spreads, reflecting less liquidity. Let's say you own a US Treasury bond. It's highly liquid, so you could sell it in seconds without much price difference. But if you're holding a corporate bond from a smaller, lesser-known company, you might find it harder to sell quickly without taking a hit on the price. All right, let's talk about the nitty-gritty of two main arenas where bonds are issued and traded, the primary market and the secondary market. First up, we have the primary market. Think of this as the launchpad for new bonds. Companies, governments, or other entities come here to raise money by selling bonds to investors for the very first time. When you hear about a new bond issuance, this is where it all begins. There are two main ways issuers can introduce their bonds in this market. Public offerings. These are open to everyone. Anyone can jump in and buy. Private placements. Here, the bonds are offered to a select group of investors, maybe large institutions or accredited investors. It's more exclusive. Now, some issuers in the primary market might be switching from private debt arrangements to public bonds as a way of reshuffling their finances. It's a way of tapping into a broader pool of investors while reducing reliance on private loans or equity. Once a bond has made its debut in the primary market, it enters the secondary market. Here, investors trade bonds with each other, not with the original issuer. This market is crucial because it provides liquidity, allowing investors to buy and sell bonds according to their needs. It also drives price discovery. Based on supply, demand, and market conditions, bond prices fluctuate here. The process of issuing bonds in a primary market can vary depending on whether it's a first-time or a repeat issuer. Debut issuers, the newbies, go through a longer, more elaborate process. Underwriters might take them on a roadshow, hosting presentations and meetings with potential investors to generate interest. This can go on for weeks before the bond even hits the market, whether it's a domestic issue or a Eurobond. In contrast, repeat issuers, those who've been here before, have a much easier time. They've established trust, so the process is quicker and smoother, with the new bonds typically priced around par value. When it comes to issuing bonds, underwriters play a big role. They manage order books to ensure institutional investors have access to the bonds, and they work to keep the spread low across different maturities. For companies that issue bonds regularly, there's something called shelf registration. This allows them to file one offering circular and use it repeatedly for quick access to the market, kind of like having a standing order in place. Now, the type of bond matters too, secured bonds. These come with extra layers, collateral, covenants, and are usually issued by high-yield companies or for special purpose vehicles. They're more complex than unsecured bonds, but offer bondholders some extra security. Best efforts offerings. Here, financial intermediaries act more like brokers, trying to sell bonds without guaranteeing the full sale. This is common for lower credit bonds where the sale is less certain. Private placements and non-underwritten offerings. Smaller or more niche issuers may skip public offerings altogether and directly place bonds with select investors. Sovereign debt issuance is a whole different ballgame. Governments typically issue debt via public auctions handled by the National Treasury or Finance Ministry, but more on that in another session. Now, let's dive deeper into the secondary market, where existing bonds change hands. These markets are mostly quote-driven or over-the-counter OTC, despite the rise of electronic platforms like Market Access and TradeWeb. Major players here include institutional investors, financial intermediaries, and central banks. One of the big factors in the secondary market is liquidity. The easier it is to buy and sell a bond, the narrower the bid-offer spread or bid-ask spread. This spread, often quoted in basis points, tells you how liquid a bond is. Let's look at a few examples regarding liquidity of various types of bonds. First off, sovereign bonds liquidity. Recently issued bonds from developed countries like US Treasuries or Australian government bonds are super liquid. Their bid-offer spread is usually razor thin, sometimes less than a basis point. In some cases, these bonds even trade on public exchanges, making them even easier to buy and sell. Now let's talk about corporate bonds liquidity. Keep in mind that new issues from high credit frequent issuers have good liquidity and therefore tighter spreads. But as bonds age or come from less active issuers, liquidity can dry up, leading to wider spreads. Distressed debt trading. This is a whole different beast. Distressed debt, which trades below par, reflects a pessimistic outlook on full repayment. Investors speculate on whether the issuer will restructure or liquidate assets to make payments. It's risky, but can lead to high rewards if the issuer recovers. Finally, there are illiquid bonds, bonds that don't trade often. Pricing these can be tricky, so market participants often estimate their value based on similar, more liquid bonds in terms of credit quality and maturity. And there you have it, folks, a full rundown of the fixed income markets, from the nuts and bolts of primary and secondary markets to the finer points of credit quality, issuer types, and investor strategies. Remember, bonds aren't just boring old fixed income. They're dynamic, multifaceted tools that play a critical role in the world of finance. So whether you're looking to manage risk, lock in steady returns, or speculate on interest rates, understanding these markets is key to becoming a savvy investor. Keep these lessons in mind, dig into those practice questions, and get ready to ace your CFA exams. Until next time, happy studying and bond trading.